Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We are going to move on. Today we're going to look at TSM, or Taiwan Semiconductor. TSM is the world's largest dedicated integrated circuit foundry. That means they design, develop, and manufacture semiconductors for other companies. Here's the barchart.com technical opinion rating for TSM. The bar chart rating is an 88% buy with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is in highly overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that TSM is well above the moving average line, so the monthly trend in TSM is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in TSM is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. Okay, we're breaking the rules a little bit here today. TSM is above the upper Keltner channel line by a few cents, 25 or 30. Since the trend is up, we want to buy a call. TSM has plenty of option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 68 days to expiration. Here's most of the TSM option chain for July 19. TSM closed at 149.26 on Friday. That means any calls on the list from 95 to 145 are in the money. Let's take a look at the profit potential for purchasing the 150 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 150 call is 8.90 to 9 even. We tried to enter at the midpoint, so we'll use 8.95 as the buy price. Our call option calculator shows the profit potential for this call based on TSM price changes at option expiration from flat to a 12.5% increase in price. We can see that if the TSM stock price is flat at 149.26 at option expiration, the 150 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 135 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 135 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the TSM stock price is up 1%, the 135 call will lose 13.7% of its value. We want that to be breaking even or better, so the 135 call does not meet our requirements. Let's see if the 115 call will work. The bid-ask spread for the 115 call is 34.95 to 36. We tried to enter at the midpoint, so we'll use 35.50 as the buy price. The 115 call works. If the TSM stock price is up 1%, the 115 call will make a 0.7% or $25 profit. That's better than break even, so the 115 call is the one we'll buy. The call option calculator also shows that if the TSM stock price increases by 2.5%, the 115 call will make a 7% or $249 profit. If the TSM stock price increases by 5%, the 150 call will make a 17.5% or $622 profit. If the TSM stock price increases by 7.5%, the 115 call will make a 28% or $995 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the TSM stock price does not make the expected move up and remains flat at expiration, the 115 call will only lose minus 3.5% or minus $124 compared to the minus 100% or minus $895 loss for the 150 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the TSM July 19 130 strike call and sell to open the TSM July 19 140 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 130 call for $22.10 and sell the 140 call for $14.70. $22.10 minus $14.70 equals $7.40. So the entry price or debit cost for the spread is $740. The call option spread analysis calculator picture shows that the spread will make a 35.1% or $260 profit if the TSM stock price declines by 5%, remains flat, or increases in price when the options expire. If TSM is down 7.5% at expiration, the spread will make 9% or $67. Creating the debit spread will allow us to collect a $1,470 cash credit to our brokerage account for the sale of the 140 call. As we said on the previous slide, this reduces the cost of entering the spread to $740. Here's a note regarding earnings reports. The next TSM earnings report is scheduled for July 18. Let's review the trades one more time. The first trade was a call purchase, said to buy to open the TSM July 19 expiration 115 strike call for $35.50. We also reviewed a spread. The spread said to buy to open the TSM July 19 130 strike call and sell to open the July 19 140 strike call at a debit of $740. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.